Very good morning. Yes, it's the big Diwali week, and we're hoping this week brings with it some cheer for the bulls who've been down and out. But hopefully things not looking too bad this morning. I know we've said that every single day last week, but this time truly I think the global picture is better. Even though the bears may be in control, a little bit of a recovery shouldn't be ruled out. Good morning, guys. You'll all look lovely.
Yeah, likewise. The two of you look really pretty.
I was waiting for that.
I'm trying to fishing.
I beat you to it this morning.
Yeah, the next 4 days or the next 5 days, we'll have to do this, right? I mean, just amazing to participate in the spirit. But yeah, I mean, crude prices may be helping even if yields are not. We've corrected so much below some key levels as well. So multitude of things to watch out for.
Yeah, and just to tell our viewers why this period of Diwali, even though it's a little somber right now, it's very, very exciting for us here at NDTV Profit. It is our first Diwali.
Yep.
It is a Profit Wali Diwali, and we welcome you to celebrate with us. What we're going to do today as well, and of course we'll do the setup and what you expect from the markets, global cues, etc., is try and give you a guide of how to navigate the markets right now. Why has the move turned so bearish? Is this something that's going to sustain? Is there a real cause of concern from what we're seeing in Q2 corporate results? So we're going to be putting all of that in perspective for you through the morning and through the day. But let's start with the global cues first up and bring you up to speed on what's happening there. So a mixed kind of a bag for US markets. Nasdaq has closed at new highs, but not so much for the Dow Jones and the S&P 500. Broader markets have remained under pressure. In fact, let's take a look at the Dow futures as well, and you will notice that kind of pressure coming in. The 10-year, meanwhile, has moved higher to 4.24% on hopes of a 25 basis points cut in November. So not too bad on the yields front. All eyes now on the November 5th elections in US. Now, the latest ABC Ipsos poll shows Kamala Harris is 2% ahead of Trump. But, even that poll says that it is so close, it all comes down to the Electoral College. So, in the next couple of weeks, the focus will move there. Brent is the big story. Crude has plummeted over 4% after Iran's statements on Israel attack. I think the other big point, which is important to note as well, is that the Israel attack on Iran has skipped all of their oil facilities and gone to their missile facilities instead, which is a sigh of relief as far as crude prices are concerned. Not that it's good, any escalation of geopolitical tension is bad, but which is why you're seeing a softening in crude prices. That's good for us. Just the point on Asia is also important. You're seeing the Nikkei up about 1.5%. That's because of yen weakening. And that's also because the ruling party has lost its majority in Japanese polls. That puts into question what the Bank of Japan will do next with the yen. The yen goes down, Nikkei goes up. But Asia overall looking okay. India is the question, and I just want to pull up the implied open before we go to our conversation in just a bit. 25 points up, not bad considering the kind of week we've had, because the India story is not necessarily highlighting what we're seeing across the world. Look at the fund flows, and I'll pull up the fund flows from Friday as well as what we've seen in October so far. FI sold once again on Friday, 3,000 crores, or DIs bought 4,159 crores. But look at the October figures. You've crossed 1 lakh crore rupees in outflows from FIs, record levels. DIs are keeping up, 97,000 crores in purchases. So, for anyone believing that you're buying at the right levels, at least mutual fund portfolios, SIPs have been nibbling in. So there's no doubt over there. Is it a good idea or not is the question. But we'll just get a check of what are going to be the big factors globally and how is India being viewed. Santosh Rao, Head of Research Partner in Manhattan Venture Partners, joins us this morning. Santosh, always a pleasure to speak with you here at NDTV Profit. Great to have you on. Let's begin by talking about crude and the kind of slide we've seen down 4%. Is it safe to say that directionally crude is continuing to be soft because supply concerns prevail, demand concerns are outstripping those even more?
Yeah, I think the reason crude prices are pretty stable despite all the, the geopolitical undercurrents, the wars and all that, and Israel attacking Iran and facilities and all that. I think that essentially from what I gather from the oil analysts and all the oil experts, is that there is enough supply to take care of any. There is no slack in terms of the demand supply imbalance. So I think they can withstand any of this unless it becomes like a major escalation attacking the nuclear facilities and all that stuff. But at this point, I think there is enough margin to take any of this, any uncertainty there. I think that's what's really causing the crude prices to stay pretty steady, especially in the US. They haven't really spiked up much. So let's wait and see what happens there. But at this point, it's not a big concern.
Santosh, hi, good morning. Thanks for joining in. Santosh, I just want to talk to you about what's happening on the 10-year in the US. As soon as the Fed eased rates at its last policy meet is when the 10-year started cooling off. Now trading at a 4-month high from the look of it. Why is that happening? And also, is this an indication of what's to come on the 6th, 7th FOMC meet? Is the market going to get a lesser rate cut than anticipated, you think?
Yes, I think that's a good point. See, the 10-year reacts to two things, the expected inflation rate and the expected growth rate. I think those are the two drivers of the 10-year rate. And what's really happening now is that the market expects less cuts than what they anticipated before when they did the 50 basis points. So that's kind of getting priced in. They think that when the job market is good, the Fed cut 50 basis points, they really spiked up the possibility of more inflation, and then there's also more fiscal stimulus here and there. So there's a lot of liquidity in the market, and on top of that, the Fed wants to continue cutting. So I think there's a risk that the inflation is going to pop up. That's what the market is expecting. And the growth rate is growing pretty at a good clip. So all those two factors are really keeping taking the 10-year yields up. So that's really what's causing. Plus you have the uncertainty of who's going to get elected. That's a little bit of that, but it's not really all of Trump or and Harris. It's really about this whole expectation that the Fed may have been too dovish by cutting 50 basis points. So let's wait and see what they do next.
Santosh, could the reverse happen actually? Because a lot of people are now saying that we are looking at a reflationary trade, and forget rate cuts. There are rate hikes in the offing, which explains possibly the underperformance of the EMs and the fund flows out. I mean, India has seen over 1 lakh crores of outflows in the month of October itself. Could that worsen, or is this the worst that we've seen in terms of flows?
Yeah, I mean, we'll have to wait and see because there's so many uncertainties. I think the market is expecting to see what's happening in the US, where the Fed comes in this whole rate pictures. So net, I think the consensus is that the last time I saw 97% of the market expects a 25 basis point again. So I think it'll stay on track to bring rates down. I don't think it's going up by any chance. There's some people said no cuts at all, or maybe increase in rates. And that's not happening. It's going to be cut maybe 25 basis points or no cuts at this point. That's where the equation is. So I think we'll wait and see because that's something that this week especially is very important. We're getting inflation data on Thursday, jobs data on Friday, and then we have the earnings reports. So we'll see, and the consumer sentiment data that came out last week was very upbeat. So net, the drivers are all very inflationary. Everything's doing well. So this inflation report is going to be very important to see where it's at. If the number is cold, I think that's going to be good. Things will be back on track. Cuts 25 basis point now and maybe 25 in the future. But at this point, if that number is hot, then I think there is a slight possibility that he might just not do anything. But at this point, the consensus is that 25 basis point cut.
You know, I think it's important to look at what's happening in India in context as well. And that's what I'm going to come to you next, Santosh. But I just wanted to pull up this perspective. And while the Indian markets are seeming a little negative, a little bearish right now, the fact is we're still up about 11% year on year. MSCI China up 20% plus year to date, but down about 4% in the last month, about nearly 3% in the last week. The same as the Nifty. The Nikkei up 13% year on year. I think the best performing through all of this is gold, 33% up year to date, while the Nasdaq, of course, US markets have also been doing well, 20 to 21%. Santosh, I want you to put into perspective what we're seeing in India right now in context of China. The sense seems to be that your global money or foreign funds are exiting India, moving to China. Is that a trend you see continuing?
Yeah, I think China hasn't followed through on its cuts so far. They announced that, but they haven't come back to give us any more details. So China is really more a temporary issue. I don't think it's a long-term issue because they have many other issues going on there. So it's going to take a long time. At the immediate knee-jerk reaction is to get money out there. The risk-reward out of India is much better. I mean, I think at this point, India is pretty high in terms of the valuations on a relative basis. So the risk-reward is much better outside. China may be temporary, but down the road is that the other emerging markets are also doing very well. So I think they might attract more money as well. So I think that's where we are. I think India is nothing wrong with India. It's doing very well. It's the fastest growing economy in the world. So there is growth in there. The issue is at what price do you get in and get out? I think that's what the debate is at this point. So I would say the money will still flow out because the risk reward is much better outside India than in India at this point, but it'll definitely come back to India. So the long-term money is still coming into India. I think that's my estimation from here.
Oh, thank you, Santosh. It's extremely difficult to predict anything in these markets with so much happening and so many moving parts. Yeah, guess as long as we can ensure that we've got the day in control, I think that would be more than enough for now. But good talking to you. We'll hopefully see you soon, and happy Diwali to you as well. Well, that was, of course, a global recap, or rather global take of what's happening. Locally, of course, things have been tough. They've been very, very tough. If you've been a bull on the street, the last week was a washout in terms of trade. It's been the longest losing streak on these streets since March 2020, and March 2020 is when you had the COVID pandemic. A quick check on how the markets have done. The Nifty was down 2.75% between Monday and Friday. Mid and small cap is where the tremendous amount of selling was obvious. Not surprising given that space of the market has been the biggest gainer and wealth creator year to date. The Nifty mid cap index was down 5.7%, small cap index was down 6.5%. In fact, traders believe that the mid cap index, now that it's down 10% from its peak made in September, is now officially gone into the correction mode. The amount of wealth that was eroded has been significant from the September 24th high that the Nifty made. Investors have lost 40 lakh crores in terms of wealth. FI and DI activity was not too bad in terms of domestic institutions continuing to buy, but FIs have sold. As Tamanna indicated, 98,000 crores is the amount they've sold every single day in the month of October due to rising bond yields and competitive valuations in China, Hong Kong, while DIIs that have a domestic home bias continued to buy to the tune of 96,000 crores in the month of October so far. Bank Nifty continues to look slightly weak. Bank Nifty slipped below 51,000 on Friday for the very first time since the 7th of October. It's down 7.5% from its record highs and 2.5% last week itself. Real estate, metals, media were underperformers. Each of these are down over 7% this week. Earnings impact was also quite painful. Counters like HUL, which are large cap in every way, have been behaving like small and mid cap stocks, declining sharply to the tune of 7%, and IndusInd Bank down 18% on weak reporting on Friday. The VIX has also surged significantly, up 7% to touch 15, and by the time the markets closed out, it was up about 5%, closing in at 14.6. While you think that the markets have had it very rough this week, which they've had, and we've sold off from our recent highs made in September, what you need to remember and keep in perspective is that the markets have been on a rally, a structural bull run for the last 4 years. So this is probably the very first time you're seeing a little bit of a correction in terms of the quantum of decline. Just to quickly highlight for you how the performance of the major parts of the market have been in the year 2024 so far. Let's highlight that and we'll take you through what the Nifty has done. Year to date, we remain significantly in the green. We may not have done as well as the Nasdaq, case in point, but still done as well as the Dow, despite the recent correction that we've seen. Sectors like FMCG are still higher year to date, significantly higher year to date. The mid and the small cap index also trading at a high. So all in all, while the last 10 days have been painful for the markets, you must remember that this is a market that cannot be in a one-way direction. No market can be. And what was also significant to remember is that every cut is a buying opportunity, and that's what's also critical for incremental money to start flowing back into our market. So that's what it's been. Going into this week, some technicals you want to track because we've taken out very significant levels in the last trading week. Immediate support on the index sits at 24,000 to 23,900. And there's a strong support. If those levels get taken out, you will be headed to 23,450, which is a 200-day moving average, which will act as a very critical level of support on the Nifty. On the resistance side, 24,600 becomes your first hurdle. Just before you take that out, the 100-day moving average sits at 24,500. So from where you stand, 24,500 would be the first hurdle, followed by 24,600. On the support side, 24,000 and 23,900 becomes fairly critical. Bank Nifty is also been on the sell side. On Bank Nifty, the support sits at 50,200. A break of that could push it all the way down to 49,600. On the resistance side, 51,100 is your 10-day moving average, so keep a track and a close eye out on that. A close above that could potentially invite buying interest that could take Bank Nifty up to 51,800. So that's what we have in terms of how the market's been, what lies ahead for the street. And I think, Niraj, while technicals become extremely critical at this stage, we should also remember that while the markets have sold off significantly, and I know on Wednesday there was so much talk about maybe taking out your profits. You know, there are assets that have made money, there are products that have made money. That sentiment changed very quickly on Friday because most investors now believe that the wealth that has been created, an exit on that may not be warranted anymore because the correction has been significant. And I think now the incremental capital sitting on the sidelines should be coming back in.
Smart money nibbled into markets Wednesday, Thursday, Friday, all 3 days. So that's the feedback that we have. And remember, I mean, it's also good to put into context what this correction has done. So the mid cap and the small cap indices had the worst weekly drop since December 2022. But more importantly, as a result of this fall, the headline number, the Nifty, because of this corrective move, this has brought the Nifty 1 year forward PE multiple to 20.2 times. This is below one standard deviation to averages. Now, for the longest time, people have been saying that the index is well and truly above one standard deviation. Now we are below one standard deviation. I mean, multiple quant indicators have been saying since Tuesday maybe there's a good time to accumulate. We haven't quite obeyed that. I wonder if close to 24,000 we see those support levels coming in as well. And mind you, India is not the isolated case. Yes, that the large caps, mid caps, small caps have all had a brutal October with the small cap index falling about 8.82%. But India is not isolated. Hang Seng in the month of October, from October highs, Hang Seng is down 10.86%. So it's not that money has flown out of India into China. In all probability, money is moving back to the US because of a possibility of a reflation trade if indeed Trump is going to come back to power, because then the money that was supposed to come to emerging markets because of a lower interest rate trajectory certainly gets reversed. And India is the easy trade to sell, right? You don't have to justify that you are taking a preemptive position of a reflationary trade. You can very simply say that you've gotten out of the market because that was the most expensive market to trade in. Reposition yourself for a Trump victory and a higher reflationary trade in the US by selling stocks in which you made money, which is India.
But Niraj, the one thing that hasn't been factored in, and you're absolutely right, other markets have also been hurting, is what we've shown in our corporate results.
Which is terrible.
This, I mean, you can't get away from it.
Yeah, this is the worst. Completely agree.
It is bad, it is disappointing, it is poor. I mean, you have banks talking about, bad loans in microfinance building up. You have FMCG companies talking about consumption not picking up, growth slowing down. Company after company, sector after sector, the cement pack numbers are truly worrying. So that is a fact.
Telling point that Q2 earnings have disappointed, And who knows what the earnings downgrades will look like at the end of the quarter.
So the Q2 numbers are ugly. You can't take away from it. I mean,
Most
you paint
certainly.
everything else in every which way. Okay, you have a Trump victory, you have global monies coming back, but Indian companies need to pull up their bootstraps.
Yes.
I mean, that's just the sad truth.
Yeah, it's been a tough week, but yes, we are priced to perfection, and that's been a big concern for us straight all along. For now, the mid cap, which has been a significant wealth creator, is in correction mode. So it's down 10% from its record highs in September, and all those are the moving parts and trade. For now, the bears still very much seem to have the markets in control as we see it. What we've also not mentioned is we've had a very, very robust primary markets year to date. 21 listings in the month of October. That is what we are talking about. And while we've talked about FI selling 98,000 crores worth of equity, DIs have bought 96,000 crores of equity in the month of October. So they've been buying all along. It's not a one-off at any stage. They've matched every FI selling in that sense. But of course, there's been pressure and we shouldn't be too concerned. Yes, we can't be complacent is what we want to keep in mind. A quick check of what's lined up this week. It is a very, very busy week ahead. You're still in the midst of the earnings season. So you have companies such as Bharti, Maruti, Adani Enterprise, L&T, Adani Power, Tata Power, Canara Bank and SBI Cards that will report numbers amongst many others in this holiday shortened week. You've got key US data on GDP growth, inflation, consumer spending and job openings ahead of Fed's November 7th, 8th FOMC meet. Manufacturing PMI data from major economies and Bank of Japan's interest rate decision is expected this week. No change on the rate is what we're expecting. In India, you've got India's PMI, which will come out towards the end of the week, and you've also got fiscal deficit and foreign reserves that are expected to be reported on the 1st of November. FIDI activity will be closely monitored. Commodities is also what you want to keep a very close eye out on. On Friday, crude was down 4%. On Monday, of course, when you come back to work this morning, it's actually declined 5% in trade. IPO market, no new main board IPOs are opening, but you've got 2 listings that will take place this week. You've also got AFCONS that is open for subscription. So it's a busy day in the primary markets as expected, and also lots of economic data locally and globally that the markets will be tracking. Let's quickly move to stocks. There have been way too many stocks that have reported, rather companies that have reported earnings in the week between Friday and this morning. I'll just take you through a few. ICICI Bank, brokerages are calling this bank a league of its own. Reported numbers that were a clear beat to street expectations. It was one of those few banks that has outperformed. It's even done better than HDFC Bank, which is a standout in terms of earnings. Net profit up 14.5%. Net NPs have remained almost stable. Gross NPs have also declined. Net interest income is up 10% at 20,048 crores. Net profit has also seen an improvement as expected to what the street was expecting. So good set of numbers from ICICI Bank. I think the bank Nifty will be betting on ICICI Bank, providing the much needed support for it to reclaim its recent levels that have been taken out. Interglobe Aviation, huge disappointment. So while we talk about crude being volatile, flight cancellations, flight delays, Indigo is bearing the brunt of all of it. They've reported a loss of 986 crores versus a profit of 188 crores. Revenues have grown 13.6 to 16,969 crores. EBITDA has fallen. Margins have dropped significantly. They have approved an investment of 295 crores in Indigo Ventures Fund 1. But bad numbers. I don't think there's any other way to put this. The stock will be under pressure this morning. DLF, great set of earnings coming in from a couple of those real estate players. Profits are up 122%. Revenues have grown 47%. There has been a tax write-back of 466 crores versus the tax expense that was seen in the same quarter last year to 112. But operationally, despite that, the company has reported pretty solid earnings this quarter.
Yeah. Just on Interglobe, first loss after 7 quarters of profit, but having said that, the big factor of grounding will hopefully ease, and it is something that the whole industry is facing. I mean, these hoax calls is definitely a pain. But I think banking is in focus. A lot of numbers over the weekend, and we'll get Harsh up in a bit to give you a comprehensive picture what did well and what did not. But the first stock on my radar is IDFC First Bank. It's a thumbs down, not a great set of numbers. Asset quality in microfinance has dragged down profitability by a far big number. Growth numbers, though, look strong. Loan and deposit growth continues. The ROA has shrunk by 66 basis points quarter on quarter. So the net interest income is up 21%. Operating profit is up 30%. Provisions have gone up 228%, which is why your PAT is down 73%. Of this, one is for an account for a government toll company. One is because of poor asset quality on the microfinance bit, and that's really what is really worrying. Return on assets has also fallen 66 basis points. Gross NPA ratio has also come down. So overall, I would say this is a thumbs down. IDFC First will see some pain point coming in. Shriram Finance, on the other hand, strong growth, sharp growth in operating expenses as well. Stable margins, strong asset quality. The only bugbear here, if at all, would be what's happening with their gold book. It's not a big part of their actual pie, but regulatory headwinds have hit. RBI action has hit their gold loan portfolio, while on the vehicle side, they've been doing fairly well. So if you look at it, change Q on Q, the net interest income is up 16% year on year, 5% Q on Q. Operating profit is also decent, up 15% year on year, 3% Q on Q. Provisions have also gone up. At Shriram Finance, overall would be a positive set of numbers. Motilal Oswal has a note out on them. They've reiterated a buy with a target price of 4,000 rupees because they're saying execution is better than vehicle finance peers and earnings are in line. So a thumbs up there, but keep an eye on that gold portfolio. That could be a bit of a concern. Inox Wind, on the other hand, looks like a good set of numbers. Revenues up 97% at 732 crores versus an estimate of 766 crores. So revenues have done well. EBITDA is up 258%. EBITDA margins have also shown a robust bump up at 23.49, nearly 23.5 versus an estimate of 17.3, and net profits have also gone up. They did have a deferred tax expense of 3.6 crores this quarter, so I would say that is one area which was well. Yeah.
Okay, well, watch out for these three, and very quickly, the top three on my radar, and by the way, there are a clutch of stocks, so it's very difficult to nail it down to 9, but let's try and do that. The top three on my radar, Intellect Design Arena is the first one, and should come up on your screen because the numbers leave a bit to be desired, really. Just look at, on all counts, effectively, Intellect Design Arena has looked slightly wobbly. So revenue is down 7.93%, 558 crores, margins lower than estimated, and EBIT margin 7.52 versus 14.3. Net profit too, much lower than estimated, 52 crores versus estimate of 82 crores. So not a great set of numbers. Conversely, Shakti Pumps, very good set of numbers, really. Just look at those numbers, and they have beaten estimates by a handsome margin because Shakti Pumps, the numbers will come up on your screen in just a moment from now, but Shakti Pumps delivered a robust set of numbers in quarter two because revenues, margins, PAT, everything did well. 634 crores, the company was expecting 500 crores at the end of quarter one. Margins at 23.4 versus 9.9, and net profit looking very solid in the quarter, 101 versus 5.84. So very likely could do well. So this is the second one. And do watch out for Texmac or Rail. Amidst slightly tepid quarters and correction in the railway stocks, Texmac or Rail has delivered a solid set of numbers too. 67% uptick in revenue, margins maintained, if you will, and net profitability looking very, very strong as well. So top three on my list this morning.
Yeah. But I think focus on banking earnings, one of the key highlights over this weekend, and a whole host of banks have put up their numbers, some good, some bad, some ugly. So which is which? Harsh is joining us for more on that.
Well, good morning. We are seeing very solid numbers where ICICI Bank is concerned. You are seeing asset quality remaining quite robust. NPA ratios not moving, provisioning remaining absolutely muted. The expectations were a provisioning of maybe 1,400 to 1,500 crore. It's come in sub 1,300 crore. So quite a beat on that count. OPEX too remained largely muted, and that's aided the ROA numbers, both of these metrics. It's the expenses which they've controlled this time around. Margins saw a decline of 9 basis points on a sequential basis, which is 0.09% to around 4.35%. But overall, you're seeing that they've controlled their expense side, which is why ROA is a very strong 2.4%. It's clearly a beat. And, the kind of numbers that they deliver quarter after quarter, really, really strong. And therefore, a big thumbs up where ICICI Bank is concerned. Shriram Finance, a solid quarter overall, even though some guidance with regard to gold loans came through, suggesting that, there is, they need to streamline from a regulatory perspective where gold loans is concerned. Overall, you're seeing margins again hold up very well for Shriram. OPEX was elevated, but credit costs also they've been able to control very well, given that some of their peers have not done so well in the vehicle space. IDFC First, it's a weak set, largely because of provisioning, large chunky provisioning coming through, also some of it contingency based, but nonetheless it's clearly impacted profit after tax, 70% down, 70% plus down on a sequential basis as well as a year-on-year basis. Is PAT the correct number to look at? But well, you want a steadiness on that number, and clearly the street has asked for it given IndusInd Bank's reaction on Friday. Bandhan Bank, very, very solid overall. You're seeing a bit of a slip where MFI is concerned. That was anticipated, but it's a better than expected set of numbers overall. A mixed set is how I might qualify it, if at all, in the worst case. But you're looking at a margin compression largely because of a shift with regard to loan preference, and therefore yields have fallen. Outside of that, it's a good set overall given the kind of environment you're seeing in microfinance.
Okay, Harsh, thanks a lot for that. So mixed for Bandhan, but the interesting thing, Tamanna, is what ICICI Bank is doing. And so many people, I remember Parag Thakkar in the last week that he's spoken to us, and so many other people are talking about how this quarter is separating the men from the boys. Yeah. Look at what HDFC is doing, look at what ICICI Bank is doing, and therefore do the conservatives in a period of time when asset quality is under question mark tend to get favor. Hitherto, we haven't seen strong evidence of that, but maybe now the street will start rewarding after what IndusInd did versus what HDFC and ICICI Bank has done versus what Bandhan has done. So maybe those two, maybe a Kotak squeezes in.
Bandhan, maybe, I would put in the positive bucket. They've not been doing too badly. Change over there, big changes in management, the numbers are not too bad. Bandhan, I would say, would be perhaps a bit of a positive surprise.
But just the size and the ability to navigate. Maybe, just maybe. Time will tell.
Yeah, okay. Men, boys, and then their teams. I don't know if you want to take
Don't
that
talk
one.
of teams. The Indian cricket team has been rubbish.
Teens,
okay.
Teens, men, boys, and then the ones who are almost there. But let's talk about the babies then. And I'm talking about the IPOs, taking this a bit too far. Samina is tracking two of them. AFCONS is open, but everyone's looking at Wari.
AFCONS has opened, and it's a solid company. But I guess Friday's sentiment didn't support the subscription number that came in on day one. Very, very muted response on AFCONS on day one, which was Friday. It was only about 10%. But just very quickly, let's take you through it. It will be closing tomorrow. So keep an eye on AFCONS. If you want to subscribe for it, you've got today and tomorrow to do it. It's a very big one. 5,430 crores. The price one is 440 to 463. And of course, the anchor investor book was fully subscribed at 1,621 crores. Let's break the IPO down for you. There's a fresh issue of 1,250 crores and an OFS by the promoters to the tune of 4,180 crores. Some solid hands have come in as expected. Anyone looking for value has, of course, jumped into this one too. HDFC, ICICI, Pru, a couple of global names like BlackRock and Fidelity, Goldman, HSBC Group, amongst others, subscribe to their anchor book. Let's tell you what AFCON does. It's a 60-year-old company which is part of the Shapunji Palanji Group. It's a flagship EPC company. The company to date has completed 79 projects, and it's not just a local player, but a very significant player in the global market. They've completed projects to the tune of 56,305 crores so far. Well, what are they going to do with the money that they raise? Of course, the promoters will take some money off the table, but they'll spend about 320 crores for long-term working capital, 600 crores for repayment and prepayment of debt. Of course, it's an EPC company and hence high debt, so no surprises there. Some of it will be used for corporate purposes, and 80 crores for construction equipment that they're looking to buy post this IPO. Well, financials, the company has been growing healthy. Their order book is also fairly large, currently stands at 70,000 as we see it. Revenues have grown by 8%. Net profit is up 9.5%. Order book stands at 31,747, which is made up of about 75% is the domestic book and 25% is the global book that they have. Margins have also risen quite sharply. Well, what works for Afcons? They have a very solid track record in large, complex projects. They don't compromise on margins because they work on very high-valued transactions or projects where competition is limited locally and globally. This is also a significant player and ranked in the top 10 worldwide in the business that it continues to perform. Well, a couple of risks that you want to be mindful of. 69.8% of its orders come from the government, so any changes in the government strategy or plans could impact Afcons pretty immediately. Financing shortfalls could impact operations, and that could be for any EPC company. There are fewer new contracts that could impact potential growth on Afcons. Valuations are at a P multiple of 36 times. So that's what you have in terms of Afcons. It's a good company. That's the verdict coming out. Most brokerages are constructive on this one. But because of the larger market sentiment, the first day subscription number was not very impressive, only coming in at 10%. The other one that the street was very excited about and literally caught the market sentiment at the right time, or defied market sentiment in some ways, was Waaree Energies. It was one of the highest subscribed IPOs in the recent times. 76 times is what the IPO was subscribed by. Again, a big one, 4,312 crores. Anchor investment was at about 1,277 crores. And the subscribers to the Anchor investor book were also some very significant marquee names, locally and globally. Now, Waaree Energies is a frontline player in the solar business, which is at the cusp of significant growth. The only other comparable in the listed space is Premier Energies, which trades at a far higher valuation than compared to Solar Energies, and of course is 1/10 the size of Waaree Energies, not Solar Energies. Financials as well have been very impressive. They've grown significantly. They're up 46% in the last 3 years in terms of revenues. Margins are up from 3.9 to nearly 14%. Profits have also grown very, very healthy in the last 3 years. Well, the future looks strong. The order book is healthy. They are acquiring orders not just locally, but globally. Valuations are also compelling. The only risk is that they do depend on some US exports, which of course could impact the business if things don't go in the way that they're hoping it does. All in all, a significant premium. Last week, the grey market premium was 100% to its upper band of price. What we have this morning is 80% higher. So what we're expecting is quite the blockbuster listing, Tamanna, Niraj. It should be a good one. We should be tracking this at 10 a.m. this morning.
Something to cheer about as far as Waaree is concerned.
I wonder Afcons.
You've allocated money to it.
You can go out and buy. Should you buy Waaree or not if you've not been allocated, I think is a fair question.
85% higher, maybe you take your time to think this through.
Just valuation is always a concern. Considering a lot of very strong growing companies have also come off, maybe people want to take it.
Yes, the other IPO, and it's difficult to predict right now in this market, but the other IPO for which we got some detail over the weekend is Swiggy. Everyone's excited about that as well. Ready to launch its IPO on November 6th. It's valued about $11.2 billion, and it's actually the valuation has been kept lower to encourage retail participation. That's one version of it. The other could be a bit of a reality check, which has come in as well. Rishabh is joining in with more details. Rishabh, I think the timing is something that Swiggy will have to keep in mind when raising money.
Right. This is, of course, one of the reasons was that the valuation has been kept at the lower band. The other is of course, the market volatility that has gripped over the past few weeks, and which is why they've decided to not go with a valuation north of 14 or 15 billion dollars, which is something that they were toying with the idea of. But it is sort of final. We are seeing the IPO come in at around about $11 billion valuation. It will continue to be an 11,000 crore crore plus IPO. So very, very large consumer IPO coming in. And the fact that this is a consumer IPO was also one of the reasons why the valuation was kept lower so as to encourage more and more retail participation, because it is a consumer facing brand. What we're also now we can look forward to are the price band details that are set to come in sometime later this week. They will be sharing that with the SEBI and then with us very shortly. So a very interesting IPO for us to track.
Thank you so much for that. So Swiggy is also in focus. We don't have the price band yet, but of course they've lowered the valuation. So maybe it's a more snackable kind of a price. We'll take a very short break. Just a quick look at the implied open before we get into that break. And we're coming back with that F&O check for you. Will we have a better week? At least we're looking like we'll open up in the green. Back for all of that and more. Stay tuned.
Welcome back. This is India Market Open. We are looking at what's happened in the futures and options space. Last Friday, it was a day of trade where we did see a lot of weakness. And, when it comes to that day, well, again, coming down to the Nifty, we did see a sharp cut there, very little change in open interest. For the Bank Nifty, again, we did see a 1.5% knockoff, but we did see a substantial increase in OI there up by 6%, so shorts there. At the moment, we're looking at a 500-point range on the Nifty based on the options data that we have so far for this particular week, with 24,000 on the lower end and 24,500 on the upper end based on the kind of open interest that we have seen. Moving on to stocks, again, a mixture of trade, but more losers than gainers. We do have a lot of traction with respect to IndusInd Bank, Dixon Technology, Shriram Finance, L&T Finance, all of them losing out, looking at shorts. We saw unwinding in UBL and Balram Puccini, Lotus Labs, Oracle Financial Services, and Dr. Lal Pathlabs looking at about a short covering. But on that note, let's get in Amit Goel of Amit Ventures, who joins us on the show right now, and to perhaps give us more clarity about what he's making of the markets and how we can, in fact, go about this. Amit, welcome to the show. Good morning to you. Thanks for joining in. Your view on the benchmark and what kind of an option structure you're looking to deploy here?
Hi, good morning, Agam, and thank you for having me on your show. Let me take this opportunity to wish you and all your viewers a very happy Diwali. Hope this Diwali is a nice and prosperous one for everyone. Now, coming to the markets. We've had a precipitous fall in the last few trading sessions owing to weak results, and there is some bit of the China talk also, the money going out. But what I do see is a glimmer of hope with respect to the price action that we have noticed in the last 1 hour of trading on Friday. We've seen that there has been some bit of an attempt to, stage a recovery, form a support at about 24,000 levels on the broad index, which is Nifty. So I do believe, and I concur with you when we say that when we see the options, the option open interest at 24,000 being support, with about 82 lakh shares of open interest on the put side and at about 85 lakh shares of call open interest at 24,500 as the near-term resistance. So I do feel that with an upward bias, we could be in a range of this 500 point. So any trader looking to take opportunity, take benefit of this, could set up a non-directional theta decay sort of a trade. I actually happen to have a trade on Bank Nifty. So if you allow me, I can take you through that.
How you're approaching Bank Nifty now?
Now, the view remains the same. What I noticed is, yes, we can all see the fall in the broad indices and the market in general. However, the last 1 hour of trade on Friday does seem to indicate that probably a short-term support has been formed at about 24,000 on Nifty and about 50,500 on Bank Nifty. Considering this, I'm looking to set up a slightly bullish call ratio spread for this week's expiry, which is the 30th of October, in which we are looking to buy a 51,000 call and one lot, and we will sell 51,500 calls, 2 lots. This is a call ratio spread in which the downside risk is flat out at about 500 to 600 rupees per lot. However, the risk in this trade is any sharp and swift up move beyond 52,000, which is where our max risk of about 5,000 would hit. We are looking to capture about 2,500 to 3,000 rupees in this trade. On the face of it, the RR does not seem to be all that great. But if we were comparing that with 52,000, if you'll notice on the charts, it does not look a likely scenario given the chart structure, with a lot of moving averages, including the 100, 50, and 20, hovering or bunching up around 51,500 to 51,800. So I do see some bit of an up move, an attempt to, move up, but also facing a lot of resistance. So again, a range bound sort of a view with a mild bias, stance.
Okay, so there you have it. Well, what we're looking to do is actually buy the 51,000 call and sell 2 lots of the 51,500 calls in this case, and this costs the 30th October expiry. So we don't have too many days to go in for, but with the risk reward, as Amit has already mentioned, that is what we're going to go work with. Amit, on that note, thank you so much for joining us and taking us through your views as well. I wish you as well a very happy Diwali and a prosperous new year. But for our viewers, don't forget that if you do have any queries regarding futures and options in terms of any position that you have taken or you want to probably think of taking, don't forget to write to us on the WhatsApp number that is being flashed for you on your screen, and we will be sure to take your queries up on the FNO show at 10:30 a.m. today. With that, it's back to you all.
Thank you for that, Agam. That is what the FNO picture looks like. It seems like there's a glimmer of hope this morning. That's what our analyst believes, especially after very important levels were taken out in trade here on Friday. It's a positive start. The street is eyeing 24,000 becomes extremely critical. On the upside, it's 24,300 that the bulls will attempt to take out. Lots and lots of stocks between Friday and this morning. Most of those earnings have come our way, but there's also stock-specific news that is significant. ITD cementation promoter is set to sell stake to Adani Group arm. The promoter will sell 8.01 crore shares at 400 rupees apiece. Anushi is standing by to give us more details of the stake sale. Anushi, what's going on? This is a big one again.
Absolutely, Samina. This is a big one for ITD cementation. Over here, promoter Italian Thai Development is planning to sell about selling 46.63% of its stake to Adani Group firm, that is Renew Exim DMCC. And with this, the promoter will be selling 8.01 crore shares at a price of 400 apiece, which comes to about 3,204 crore. With this, there would be also an open offer which will be triggered, as more than 25% of companies' voting shares acquired will lead to an open offer trigger. So your additional offer is being made to buy 4.46 crore shares, that is additional 26% stake of the company, and the open offer price, if you look at, is at 571.68, which is a 6% premium compared to its Friday's close. So this totals up to 2,553 crore along with the 3,204 crore earlier mentioned. So with this, if the open offer is fully accepted, then the Adani Group arms firm's total stake will increase to 72.64% stake in the company, and Adani Group arm will have its own in-house EPC division, which will look over the construction and other related works that ITD cementation is involved in. So this is what the picture is developing for ITD cementation.
Okay, well, certainly watch out for this one, and should be a stock that will react. In fact, I'm guessing it will be a part of our watch list. So let's try and take the profit watch list. This is a set of stocks that are there, top of our mind. And therefore, it becomes important to highlight to our viewers, because in one summation, you get an idea of what are the top 9 stocks that are likely to react in the session today. So definitely keep a keen eye out for this watch list as well. And let's go across to that. So the first one is Shakti Pumps, strong Q2, Inox win, beat estimates on margins and profit after tax. ICICI Bank delivered a very strong quarter. ROA is at 2.4 and expected to inch higher. Jefferies says it's in a league of its own. ITD cementation, as Anushi said, to sell equity to the Adani Group arm, stock may react. And Texmaco Rail delivered a very strong quarter too. Watch out for this one.
Right, we also have a few stocks that will be under pressure this morning on back of some disappointment on earnings. Syrma SGS, the revenues have grown below expectations. The stock will be punished in trade. IDFC First Bank provision has impacted profits and the street isn't pleased. Intellect Design Arena second quarter results have shown negative performance, and with Coal India, the second quarter numbers were slightly below what the street was expecting on revenues and margins.
Yeah, there are quite a few others to discuss as well. I think one that comes to mind is JK Cement, very poor set of numbers, so that might see a bit of pain point. But let's get on with the technical call. Kush Bora joining us this morning. Soni Patnaik with us is Aditya Shah. Welcome to all of you. And well, we've started off the festivities here. So wish you all a very happy festive season. Soni, let me start with you. Are we going to see some cheer, at least on the indices today?
Hi, good morning, everyone. Thank you for having me on the show and wishing everyone a very happy Diwali. So if we talk about Nifty, definitely the structure has gone quite weak. It broke below 24,200 and even Claver closed below it. Anyway, right now, 24,050 may act as a temporary support. It can bounce or maybe rather see a dead cat bounce towards 24,200, 250. If it's able to cross that level on intraday basis, there could be another 100 odd points of a short covering move that can be seen. However, positionally, this index remains quite weak. The continuation of the sell-on rise will continue as long as it's not able to cross above 24,500 at the bare minimum. A worry over here would be Bank Nifty, which actually broke below 51,000 support. It even closed below it. So that's a bit of a worry over there. On immediate basis, 50,400 followed by 50,150 are the two support levels to watch out for. If there's a weekly closing, we can see Bank Nifty continuing below 51,000 on a positional basis that has gone weak. So there could be opening gates towards 49,500 as well. So I think that's a level to watch out for. And, only if it's able to cross 51,500 odd levels, you can see the short covering getting in for Bank Nifty. But it seems a bit far-fetched considering how the short positions have built up on Friday with aggressively around 9% on the short side. So both the indices have a weak structure. Sell-on rise structure is continuing as of now.
Okay. Let me get a quick index check from Kush as well. Kush, do you see now an opportunity to buy beginning this week? Mood changing?
Hi, morning, Tamanna. First, a very good morning to everyone. And happy Diwali, happy festive season to all of us. Let's hope the markets to bring some cheer right after almost a month long of dropping. But yes, if you really want to look for positives, you have to dig deep, like really deep in terms of data points as well, because there aren't any positive divergences just yet. Nifty hasn't barely or rather even remotely come close to those oversold territories from where there could be a rebound. But again, if you do dig a little deep like I did, there are some positives to be had, because 24,000 is a medium-term support zone that should be respected. Interestingly, Friday's fall on a lot of stocks also wasn't really clubbed with as heavy volumes as it has been for the most part of this month, so which is also a healthy sign. And also the monthly RSI, that has actually formed the base of the cautious view that we've discussed for a while now, which had hit 83, is now approaching that support zone of 67. So a couple of points suggesting that the risk-reward ratio in the near term may not be as favorable for a short position. We will look for a rebound trade, but again, we won't preempt it. As in when on the daily basis, on an intraday basis, the markets do indicate, that there is a rebound to be played, we will, perhaps initiate a long position, just not yet. Also, on Friday, we discussed that, there is a round two of selling that might come about, after, let's say, a dead cat bounce or a technical rebound. Not sure if entirely the first wave of the selling has also been completed, given how the index moved on Friday. So cautious warranted, on the Nifty. But yes, from here on at least, near-term perspective, short is not a position that you want to take. We'll look for rebound.
Okay, look for rebound. I have to take a very short break, but we'll be right back. Top stock picks. We'll take Aditya's call. I'm sure he has a lot to say about all of the banking results which have come in. All of that after this break.
Welcome back to India Market Open. Does the spirit of Diwali and the sentiment around Diwali lift our markets? Here are the first trades. Will be all over the place. We'll of course get to them once they settle down a bit, but I'll watch out for ICICI Bank. Does that really have the strength to give the support? Remember last week, a day it was ICICI, a day it was HDFC. Can ICICI Bank do the trick today? Let's pull that stock up for you and see what it's doing in the first half, because really that is the big one to monitor. In addition to, of course, Interglobe Aviation, maybe down because of the commentary that has looked very wobbly in Interglobe Aviation's case. 10% slam dunk. This may change really. Let's wait and watch. I really doubt it will not be 10%, but let's wait and watch what happens here to some of these stocks. Okay, before we get in stock ideas, I think Aditya Shah is with us as well to take a quick stock of what some of the results have looked like. Aditya, since Interglobe is top of mind, maybe ICICI Bank too could be, but I want to start off with Indigo. What did you make of the numbers? More importantly, what did you make of the commentary? Because they've sounded very cautious for what will arguably be a very busy flying quarter.
So good morning, Niraj. On Indigo, I've time and again warned the market cap of the company is extremely high. The stock has rallied nearly about 100% in the last 1 year. However, the results that we are seeing due to volatility in the crude oil prices, as well as the competition now starting to rev up in terms of Tata's coming into one brand, which is Air India. Indigo will start to face the heat over the coming next 1 to 3 years. So my perspective really is this is a one-off quarter. We've seen crude oil prices also coming down. So that's not really the major pain point for Indigo per se. But now the expensiveness of the stock combined with competition framing up in terms of Tata's is a real concern for me at this stage. And I will try to avoid the stock. On top of this, the groundings of their A320 Neos is still a concern, and that's not being sorted from Pratt & Whitney per se. So my perspective on the stock is absolutely very clear. It's a clear avoid. You cannot be into an industry where a lot of factors are beyond the company's control, and the competition is really intensifying at this stage. Although a great company, we've seen the promoters selling big time on the Indigo stock, and that's a very clear indication that a short-term top for the stock is starting to get formed. Aviation is a multi-year decadal story. However, a lot of it is priced in the short term for Indigo. So a clear avoid at this stage. The results are not very good, not very enthused with the sector valuations per se, and be very, very careful in the entire sector as of now.
Aditya, is if you're sitting long on this stock, fresh allocations sure not warranted, but I think analysts and investors would be concerned if they've sat on this counter over the last couple of months. Sony, but we're getting close to market open. Top trading ideas this morning, what do we have?
So, Samina, we have officially recommended a buy and a sell in a balanced approach. The buy is for Bharti Airtel to buy on dips with a stop loss of 1690 and a target of 1730 to 1750. That's the first buy. The sell recommendation over here is in November futures for Titan. So one can sell around 33 with a stop loss of 3365, a target of 3100 to 3050. So this is November futures.
Okay. Right. So, Kush, sorry, what about you? What are your top stocks that you're recommending this morning?
But as the case has been for a while, a mix of long and short. Coforge is a long. The stock has seen a very smart rebound from the 50-day moving average and continues to impress with fairly decent volumes even on a weekly basis. So the targets for this one are 78.80 and 80.40 for the long position. 7600 is where you place your stop loss. On the short side, you've got Bata, which continues to reel under pressure, and every bounce has been taken as an opportunity to sell. So on the short side, Bata with targets of 1345, 1330, and the stop loss on this one comes in at 1385.
Okay, so those are some ideas for the morning. Hopefully you can work with some of those. Pasupati Advani, founder of Global Foray, also with us. Pasupati, good morning. Thanks for joining in. We were talking about some of the banking numbers and how they've turned out and how maybe the street will bifurcate between an ICICI and an HDFC versus the rest. We'd love to think how you think about how banking is shaped up in the quarter. What is it that has stood out for you in the results? Is it ICICI Bank? Is it something else?
No, I think what's happened is that a lot of banks have chosen this quarter to draw blood, and they've given taken some surprising losses and all. As you said, there is three bifurcations. One is the ICICI Bank and the HDFC Bank. Second is the smaller private banks. And thirdly is the Indian PSU banks. So, they're all sort of basically consolidating. I particularly am not very fond of the fintech space. And I think that the fintech space is going to now sort of create havoc in the banks. So it depends on how these banks have lent to these fintech companies. But I think it will take time. So it will be a slow, painful drawing of blood, as I said. Thanks, Niraj.
Mr. Advani, hi, Tamanna here, and I must say, absolute pleasure to speak with you after so long. And we're talking at a very important time, where concerns. You talked about banks briefly, but if I were to ask you to widen that lens a little and look at Q2, are you worried with what you've seen so far with corporate results?
Well, Q2. It's always good to show. Sort of take all the sort of losses that you want to take, because then Q3 and Q4 look better. So I'm not so pessimistic about that. But where I am pessimistic is the fact that, where I am optimistic is the fact that, it looks like the Israel situation seems to be getting a little calmer. Crude has come down, which is also very good for India. So I think, the macro around us, around in the external factors are definitely going to make a big difference. And I think that's going to help our markets. Again, companies have taken a chance to, show whatever losses they're going to show. So I am expecting Q3 and Q4 to look better for all these large companies.
Hi, Mr. Advani, it's Samina. What is the advice that you're giving your clients right now? Do you buy into this weakness? Do you stay on the sidelines, wait for a better time, or just stay put?
So I think the big equation for right now is what's going to happen on November 5th in the US with the elections. And obviously, I think a Trump winner would be good for markets. A Kamala Harris winner would be not so good for markets globally. And I think some of it will be affected here. There's a lot of watch and wait. If you're looking at all the markets today, you're seeing the Far East markets. Most of them are very quiet, and everyone's sort of waiting till next week. We in India have also got Diwali between now and then, so I think there's a bit of optimism for that. And, so I think there's a bit of bounce. But I think the reality is we're waiting for November 5th for the fun and games.
Mr. Advani, are you concerned about the significant foreign outflows from India?
No, I think that was bound to happen because, if you look at our market, we are sort of considered to be slightly on the overvalued side. Plus, China is sort of giving some rumblings that they are giving some opportunities and doing some cleanup. Again, I think they're also waiting for the elections, and then they will decide whether the sort of things that they're going to pass will be aggressive or they'll be soft, depending on whether Trump's in the White House or Kamala Harris. So I think next week's going to be really very interesting. I'm guessing we don't get a result on the 5th itself, but it would be nice if we do. But, I think that China is waiting to open the doors or not open the doors. But certainly a lot of the money that has come out of India has gone into Japan and also into China, which look like, markets worth investing in.
Okay, so that's the first set of things that we now have to focus on. Then some of the stocks which were taken a slam dunk, I just want to see. So Poonawalla FinCorp had this big down, 17% downtick. Let's pull up that stock. It's down another 2.5% in the session today. And is looking, God bless Tamanna, very, very wobbly currently. So the question really is, what happens to some of these stocks which are getting damaged very, very brutally? Now, Aditya, you saw Poonawalla FinCorp. There was also this letter floating around. I don't have the knowledge of the veracity of the same, but the results itself didn't look very good. What's your sense here to Poonawalla or some of the NBFCs wherein the numbers have looked very wobbly?
Niraj, so I will set the record straight. Poonawalla FinCorp did a lot of crazy things which I don't expect a lender to really do. They sold off their secured housing loan business to another firm, and now completely went into the unsecured side of it. Now the new management is blaming the older management for aggressively going into the unsecured space when the RBI Reserve Bank of India itself was cautioning the entire market about unsecured space per se. Now what has happened is they have taken a 666 crore of provision on the small ticket size loan when the credit cycle has really turned around. Now it is very difficult to trust the management per se, because out of nowhere they have already come out with a significant loss, and now there's no understanding of how the company will start to move forward. So rather than investing time on social media and paying influencers on promoting the stock, the management must start to build a secured plus unsecured book, and that's how they are going to protect the company per se. So no love lost for Poonawalla FinCorp. They really need to work on the turnaround of the business, and it is not the next Bajaj Finance per se. Fund managers have got it all wrong, and now all the smaller NBFC will start to face the heat as the credit cycle turns. Micro lending, you've seen IndusInd Bank take a 18% hit on Friday because of their poor results per se. The cycle has turned. All smaller lenders will continue to get hit, and that's where the class of ICICI Bank and HDFC Bank is starting to come about.
Credit access, Grameen, is in that same bucket for you? Very quickly,
yes.
Aditya?
All micro lenders are clear avoid right now at this stage.
Okay. Very quickly, let's get Harsh on for the big brokerage call this morning. Harsh, what's on your list?
Well, you have HSBC on Dixon Tech, very constructive, hiked their target price from 14,000 to 16,600, offering now a 10% upside versus market prices. They believe that Q2 has been significantly better than what the consensus estimates were. In fact, even the acquisition of the mobiles business, they have grown at 110%, which is fairly healthy. They believe that this one will continue to compound in terms of EBITDA at 50% over FY25 to 27, so very healthy there, and also EPS CAGR of a similar number. They're assigning a higher target valuation on this one at 70 times versus the 63 times earlier, and they believe that improved confidence in Dixon's ability to capture opportunities profitably is what is keeping them very interested in Dixon. Of course, just about a 10% upside, but it's very interesting the way in which this note is structured.
Indeed, Harsh. This one is an important one, and it has been such a wealth creator for investors in the recent past. The stock in pre-open trade is expected to see a gap up after, of course, what we saw on Friday, which was not a great day for Dixon, despite earnings largely beating street expectations. Sony, I don't know whether you've talked about how you would play ICICI Bank this morning. If we do get a gap up in the first few minutes of trade, would you buy into that? And also anything on consumption, because these stocks have been beaten down all through October, and there's a recovery that's got to come, even if it's a dead cat bounce. I'm assuming the HULs of the world should see a little bit of a bounce back. So any trading opportunities between the banking names like iBank and consumption names?
So, Samina, if we talk about ICICI Bank, it has been holding quite strongly above 1220. Even in Friday's volatility, we saw the stock never breach that level. It was indicating that it can test somewhere around 1300, 1320. That's the level to watch out for. So on today's gap up, if it's sustaining above 1260, it becomes a buy on those dips, but with a very strict stop loss of 1260. And a target of 1320 can be seen. So if it's able to sustain these levels, not immediately jump right after the gap up, but maybe just give a 5 or 10 minutes of a break before getting into the trade to see if the levels are getting sustained. If you talk about the entire consumption space, it continues to look quite weak rather. And the only stock that can be accumulated on a dip would be ITC. Now ITC is holding above a 200 EMA, which is around 465. So it becomes a sort of a dip, accumulate on dip around 470, 465. That range should play well as a good support. The stock can perform, however, it becomes a good medium-term play. So I think anywhere closer to those dip, one can accumulate, and the stock can see heading higher towards 520, 530. More of a positional play rather than an intraday play.
Okay, Kush Bora, 20 seconds. Your top call for the morning.
Yatharth Hospitals has done well, good volumes. Targets are 685, 670 and 685. On the downside, you have a stop loss around 640.
Okay, well, so those are some targets to work with. 15 seconds for the markets to kickstart trade. Keep in mind, it is a lot of stocks in focus. Interglobe Aviation is certainly something that we'll highlight, but ICICI Bank from the index, probably the main force for the Nifty today on the positive side, if it is indeed like that. Well, 0.41% higher and the Nifty Bank up 0.5%. So clearly, ICICI Bank working. Mid caps and small caps very quickly. Are they moving at all? about 0.25% for the mid caps, small caps, 0.5%. Let's see if it's a dead cat bounce or no. But bring up the heat map because ICICI Bank is taking the Bank Nifty higher for sure. And Shriram Finance too, 4.7% higher from the financial space. But ICICI Bank, 2.5%, really strong move. Bharat Electronics, a couple of brokerage notes constructed there. BPCL doing okay. Sun Pharma, the crude price fall essentially. We didn't mark that, but BP, HP, IOC, maybe some paint companies, all of those would be in focus. A lot more green, very little red. JSW Steel stands out for the 3% down tick today. Coal India, wobbly numbers, down. ONGC, crude down tick, down. L&T ahead of the numbers, down about 1%. Bharti Airtel could be interesting. Sony had mentioned it as an idea. Let's see if this dip is something that she buys into or no. But more red, more green than red, even though the markets have cooled off and ICICI Bank has strengthened, Shriram has strengthened. So financials pulling out a trick, Tamanna.
But strength in the market still, you have to wait and watch whether you will actually see that kind of strength in the market because markets are coming off apart from those clear winners on top. Let's just look at the sectoral heat map for a second before we go to specific stocks and it's all about results today. PSU banks, the Nifty PSU bank doing fine, finance banking, so that whole lot doing largely okay because of a couple of heavyweights, Shriram Finance and ICICI Bank largely. But on the lower end, the Nifty CPSE, energy stocks taking a beating, perhaps crude prices are hurting there. Not half bad, definitely more green in the broader markets as well today. So after the drubbing of last week, some relief over here. But let's look at specific result impacts because it's all about result. Syrma, Bank of Baroda, Bandhan. Let's pull that up first in the lot of three and look at how they are responding to their numbers. Syrma doing well, 3% up. Decent set of numbers. Bank of Baroda and Bandhan was not too bad. Bandhan, we talked about this in the morning, definitely in the bucket of banks which have not disappointed this quarter and under the new management as well. Nearly 6% up. Bank of Baroda also doing pretty well in today's market. I want to pull up Shriram Finance. We talked about it briefly, but also CDSL. Shriram Finance 5% up. CDSL also a good set of numbers that have come in, about 3% up on CDSL. IDFC First, Inox Wind are the others that we should look at. IDFC First taking a knock to the chin. I mean, this is a KO this morning, 8% down. Inox Wind, a good set of numbers on our watch list as well, about 3% up. Interglobe is the other one that we need to talk about. They've turned a loss after 7 quarters. The outlook and the commentary has not been great. A solid 10% down on Interglobe. So it's all about the numbers, but I would say that the overall mood is not as bad as perhaps we've been seeing. We'll have to see if we sustain those, Samina. That's really the question.
It takes me back to last Diwali. Exactly before the moderate trade last week was last year. At this time was actually a tough time for the markets. And then the markets turned around and then we know exactly what happened in the last 1 year on the street. Nifty 500 is in positive territory, so that's a little bit of positive news. But I don't know what's happening in Archean Chemicals. If you can pull that counter up, it's your top gainer on the street. Volumes are okay. They're not over the top, but the stock is up 14% in terms of trade this morning. It was higher by 15% just a few minutes ago. So going from strength to strength in Archean Chemicals as we see it. Asset management companies are looking good. UTI Asset Management is up 8%. Yes Bank post earnings is seeing a reaction, up 7%. Bandhan and Syrma, Tamanna highlighted for you. HPCL crude has gone back down 5%, which is good news for HPCL. The stock sees a 6% up move in trade. CDSL is high by 1%. Angel One is up 3%. KFin Tech is up 2%. DLF post earnings is up 3%. Macrotech Developers, if I can pull that one up while we take a check of earnings. DLF up 3%. Macrotech up flat as we see it, despite the fact the numbers were largely better than what the street was expecting. On the sell side, no surprises there. Interglobe Aviation is your top loser. The numbers were very disappointing and the stock now is bearing the brunt of that. 10% lower is what we have. Poonawalla FinCorp, there's been some reports recently in some sort of post doing the rounds on social media about a few unhappy employees. Maybe that has an impact, but Poonawalla FinCorp not looking good in morning trade, down 6%. Credit Access Grameen, Tamanna mentioned, is up down 6%. Intellect Design, numbers were weak. The stock is down 6%. JBM Auto is down 5%. IDFC First is seeing weakness. Coal India, numbers weren't good. The stock trades with a cut of 3.5%. ITD cementation as well, while we are at it. Brigade Enterprise down 3%. ITD cementation is seeing a cut of 5%. Shareholders potentially not happy with the deal that they're getting as they sell stake to Adani's Enterprises arm. Brigade, on the other hand, seeing a 2.5% correction. Adani Enterprise will report numbers today. The stock is looking lukewarm ahead of those numbers. So that's the trade. It isn't a great morning, but it's not too bad. The start of the week, giving up gains as we see it. The Nifty 500 was up 0.3%, now trading as flat as we can. The Nifty has moved into negative territory. Actually, the Nifty 50 is up about 60 points, but the broader markets aren't looking too well placed in early trade. Praj Industries seeing a cut of 5%. Sony, what are you making of market open? What is happening in Archean? Have you been tracking this one at all in terms of chart performance?
So if we look at Archean, then certainly today the way it has given a trendline breakout, it's just almost trying to hold above the 200 EMA resistance, which should act as a support, provided it's able to close above 670, 671. The stock can see a positional move towards 725 to 740. So I think that's very important to watch out for this. Decent volumes as well in today's gap up opening. So I think it's all about holding and defending the 670 level.
For Archean, I would love to know, Kush Bora, what do you do with the two Nifty leaders, Shriram Finance, ICICI Bank, at these prices?
So, ICICI Bank. Yeah. So, Niraj, ICICI Bank is something that you can accumulate. I wouldn't say that, go out and buy for a short-term positional trade because, the stock has given up gains. But if you're in it for a medium term, then yes, this zone of 1250 where the stock has consolidated for a while will continue to act as a very strong support zone. So from a medium-term perspective, ICICI, one of the outliers, not only in terms of results as you highlighted, but in terms of price performance as well. From a medium-term perspective, ICICI is a buy. Perhaps 1250, 1240, that zone should act as your stop loss. And on the way up, you're looking at 1325 and 1360 as your targets. Shriram Finance, not so much just yet. There was a trendline breakout that we saw today, but it's given up most of those gains, or at least quite a few of those gains. So you have to be a little watchful. A close above 3350, which I know is still some distance away, but close above that level will put the stock in the near-term upward trajectory. So bullish on ICICI Bank, a little cautious on Shriram Finance.
Okay. Indigo is the one which is the big sulker in trade, and look at that. Now, this is despite crude prices at 68. So that tells you something's off with Indigo's commentary, which is hurting, right? And Aditya spoke about this at the start of the show, but Pasupati, I'd love to come to you. I mean, if you have always wanted to buy Interglobe Aviation because the world is flying, India is flying, rates are higher, etc., crude below 70, Goldilocks scenario. A stock is available sub 4,000. Would you buy, or is the muted commentary a concern?
I think the muted commentary is a concern. Air India is becoming a serious player, and they're getting their act together. And aviation is very tough it's a super tanker type model, so it's very difficult to get out of the way. And I think that any institutional shareholder of Interglobe is having thoughts, given that Air India's, you can only go down from the top. They had more than 50% share and they're losing it. So I think and Air India is going to be definitely up there. So it's going to be an interesting space. Maybe Air India will get listed soon. So that'll be fun too.
Yeah, very quick view on what you made of what's happening in the consumption story in India. Early this year, we were all betting on a rural pickup, but no one was talking about an urban slowdown. Now, the rural part of demand has picked up. Urban, unfortunately, slowing down. Raw material prices are on the up move. Inflation is a worry. How do you play the consumption theme in India?
Well, I think you have to go back to the basics and buy the big guys again. And buy something like a DMart, even though it looks expensive. I think that that should be looked at because, at the end of it all, people are coming to shop in the rural areas, and I think, and the urban areas, and DMart's one of the places where they go. Again, Jio will be a player later, and God knows if any others are going to get involved. But certainly, those two are the big players for now.
Okay. Poonawalla FinCorp feeling the pain, Phoenix Mills on its numbers feeling the pain, Credit Access, Grameen, IDFC First, Interglobe. Interglobe is of course the big loser of the day. What's working? Bandhan Bank, Yes Bank, CDSL. Aditya, are you tracking CDSL? And were you enthused with the numbers? Is the capital play at least one safe pocket for some time?
So yes, Tamanna, it's our portfolio stock. CDSL has taken a march on NSDL and they continue to do extremely well. The results were exceptionally really very good as expected. However, the stock price has rallied and the stock price is really very expensive at this stage. Remember, we are in a bull market and we have not seen a meaningful correction to test how the retail investors will really start to play out. A meaningful correction of about 1-2 years or a deep correction of about 20-30% very quickly will then start to test the resilience of retail investors that we've been seeing. Over the last 2 to 3 years, no meaningful correction has really happened to test them. So my perspective is a great company. However, valuations are extremely expensive. No new positions should be taken here. If you have the stock, you should continue to ride the momentum. But it will, to my opinion, it will also be a cyclical play where downturns will come in when the stock markets start to correct.
Sony, anything that's you've spotted in the last 10-12 minutes of opening? HPCL also seeing a wild swing this morning, probably on back of lower crude prices in early trade. Apart from that, you've also got asset management companies that are looking good. So UTI Asset Management is up and about, up 7.5-8%. The other asset management companies trying to play catch up. Anything in the OMC place or asset management universe?
I think OMC, overall, although if we talked about HPCL, I think there's very strong resistance around 400. The stock has become a sell on rise. So, if it's not able to sustain above those levels, any move towards 400 becomes a good sell on rise. And, only above that level, you can see some amount of short covering. So would like to avoid the entire OMC space. The structure is quite neutral for the day. I think the similar for the AMC spaces also as well. So, but talking about just one particular stock, HDFC AMC, which has given a break below 50 EMA today morning, and the stock continues to remain weak below 4,400. So it's a good sell, keeping a stop loss of 4,400 and a positional target of 4,200 can definitely be seen
today.
Okay, last top call, Kush. Anything that is looking exciting?
Deepak Fertilizers, extremely exciting in a market like this, at least, because the 1135 resistance taken out quite handsomely, pretty decent volumes on the back of, or rather, for the early minutes of trade. This is one stock that can be considered on the long side. Now 1130, 35, the support zone will start acting as your stop loss, and 1200 and higher levels will start acting as target. So Deepak Fertilizer is one more stock that is standing out in a market like this.
Fertilizers is a standout as per Kush, but
just one quickly, Tamanna, just look at Yes Bank. I don't know what's going on. I mean, of course, its earnings, the stock was up 3% only a few minutes ago, 10% higher now on Yes Bank. 10% on Yes Bank. So I think this is another outlier in terms of the response. Sony, very quickly, 1 minute to go. Buy Yes Bank at 21.28.
So definitely an avoid, Samina in the stock, although one can see it crossing the 20 EMA today. If it's able to close above 21.2, then it becomes a buy. From this level, you can see it heading towards 23. But a close below the 21.2 is going to be very crucial. So one can just wait and watch for the day and see how it closes.
It's at a crucial technical level, but looking very good as we see the second biggest gainer on the Nifty 500, followed by Archean, of course, up 12%, Yes Bank up 10%. Well, it's the thick of the earnings season, and we are part of all the action that's happening. We caught up with the joint MD and CEO of JSW Steel, Jayant Acharya, to talk about their second quarter results, which was impacted due to the pressure of lower steel prices.
Quarter two was a challenging quarter. As you said rightly, the international prices were weaker, and that resulted into domestic prices also reflecting the same. we were able to manage that through offsetting through costs, and that by and large gave us a similar EBITDA to what we had for the quarter one as well. The Indian operations did quite well. I think the Indian operation, the production was the highest ever, the domestic sales was the highest ever. The EBITDA was actually a little better for Indian operations than the quarter one. Our international overseas subsidiaries had their challenges with respect to the pricing environment, as well as a shutdown which was there in Ohio for a maintenance. But I think on the exceptional item which you asked, this is with relation to a mine in Orissa, which is the Jajang iron ore mine, which we decided to surrender because it was becoming uneconomical to use this low grade which is left in the mine. And that is why we decided to surrender that. And we have taken a provision to that extent in our books in quarter one.
Got it. And what will be the implications of the closure of the said iron ore mine?
It will be positive. Basically, because this particular mine was of a very low grade, which was not economically viable to use, because the specifications did not result in a cost advantage. So therefore, we decided to surrender it. We have other mines which are able to provide a better quality, which is required by us. So therefore, surrendering this mine won't have a negative impact. Actually, it will have a positive impact because the quality of the alternate material will be better.
EBITDA and realizations per ton have also taken a hit. What's the outlook on pricing for the rest of the financial year?
So, in China basically has been a key player in the international market, as you're aware. China exports have increased by about 20% plus in the first 9 months. However, the China stimulus announcement has been positive. That has been taken well by the market at large. Not only the stock market, but I think the commodity markets also reacted positively to it. Steel prices also reflected an improvement. We saw a similar improvement in India. The prices in the month of October went up after bottoming out in September. H2 being a seasonally stronger half, we expect that the pricing environment will be better. We see from a cost positioning point of view, our coking coal costs are going down. Last quarter, our coking coal cost went down by about $27. We expect in this coming quarter also the coking coal cost to go down by $20 to $25. It's through one is the international prices went down, and the other one is that we changed our blend and sourcing to make it more sustainable. So therefore, we are benefiting on the cost. We expect slightly improved prices. We have increased the prices by about 1,000 to 2,000 rupees in the month of October on different products. So we expect that to sustain on a seasonally strong quarters ahead.
And if you could give maybe a range that you see EBITDA per ton stabilizing at?
I would not like to comment on an EBITDA per ton or an EBITDA spread specifically, but let me put it this way that we have new capacities which are coming on stream. JVML blast furnace has been commissioned. The SMS is under commissioning. We have seen the BPSL capacities getting completed. So in the second half, our volumes will be much higher. Therefore, our guidance of sales and production, whatever we have given, we stand by that. So increase in volume will result in increase in absolute EBITDA, and that will improve the overall profitability of the company. It will be difficult to comment on the spread at this point of time.
Let's now talk about demand. Now, in terms of customer-wise segment demand, what's working? Has there been any impact in the recent slowdown in the auto segment?
Well, as a matter of fact, our sales to automotive went up. We actually had, in H1, we had the highest ever automotive sales. There are different reasons for it. But so, first of all, just to reflect back on the demand last half, the India demand first grew by 13.5%, which was a very good growth, in spite of the fact that we had elections and a monsoon disruption in between. The automotive sector has seen some impact with respect to the growth, as you rightly said. But because of various approvals, because the auto typically takes time to approve a particular steel product. So therefore, from a penetration point of view, I think we had a good sale. We see infrastructure CapEx picking up in the second half of this year. That will drive steel demand. We also see a better monsoon resulting into better rural recovery. We have already seen two-wheelers going up, appliances going up. The third piece is the energy transition. We are seeing more demand coming in from solar and wind, which we are ourselves also adding in capacity. to turn to more of green, let's say, and reduce our emissions. So the demand on the energy sector is also going up. Overall, I think we are quite positive for the second half. Increased volume from our side will help meet the demand, and I think that will improve the general EBITDA for the company as well.
Export sales is also something that was significantly impacted with a 43% drop. Could you maybe give us some understanding into the current difference between Chinese and Indian steel prices, and how could this shape up going forward?
So in Q2, yes, the international prices, specifically from China and FTA countries, zero duty impacted us. We have seen an increase in international prices after the China stimulus. So we are, I think we are seeing a situation where probably international prices from China and domestic prices are near parity. I think we will see some moderation in the winter months from China. Their production has already moderated in the month of August and September to about 78 million tons. Hopefully that will result into lower exports out of China, but that's a hope. We'll see how time goes. But I think on a pricing environment, because most of the steel makers have narrow margins, my sense is that the pricing has bottomed out and will improve. We have seen that in India as well, where prices in October have improved. And that should be positive in a seasonally strong quarters, which we see ahead.
The company has also lowered its FY25 CapEx to around 16,000 to 70,000 crores. Why was this revision made, and why has the BF3 expansion been rescheduled to next year?
Yeah, so specifically on the CapEx, we had planned about 20,000 crores. You're right, we have recalibrated a bit to 16 to 17,000 crore, primarily on account of two reasons. One, the slurry pipeline project we are transferring to JSW Infra at arm's length pricing, and that would give us a reduced CapEx because that would be now spent by the infrastructure company. And the BF3, where we have postponed the modification, that also releases some CapEx in this financial year. That's why these are two main reasons why the CapEx has been recalibrated. None of the critical projects have been impacted. However, if I look at why the BF3 we had to reschedule, that is primarily because the JBML blast furnace got delayed and the commissioning has just happened. The ramp up will happen in Q4. So after the ramp up is stabilized, we will take the shutdown of the BF3 after April. So that's the reason for the change, nothing else. And that has also caused recalibration on the CapEx.
Got it, Mr. Acharya. Q2 also saw a 6% quarter-on-quarter increase in debt to over 85,000 crore rupees. Why was this uptick there, and what levels could debt remain in FY25 end?
So, debt uptick, as I said, we have spent about 7,850 crores of CapEx. We had a tough H1 from international perspective. So one was the CapEx. The second one was investments in a coking coal mine, which we have done. So we have done an investment in Nalwala coking coal mine. We have spent $120 million on that to have a 20% look-through interest. And the third reason was that working capital basically has increased, primarily on account of some inventories which have got increased on lower exports. Also, new inventories for the upcoming capacities which are coming on stream. As we go into the year, we will be releasing some of these working capital. Increase in EBITDA from additional volumes will help us deleverage as well. So those should improve the debt positioning, and we expect the debt in absolute terms to go down as we end the financial year.
The company has also recently announced the acquisition of the ThyssenKrupp Electric Steel India company. How will this be funded, and what was the rationale behind this venture?
So ThyssenKrupp Electrical Steel is a joint venture between JSW Steel and JFE. Both together have acquired the asset. This is a CRGO asset, which is primarily a product which is imported in the country. This goes for transformers and generators, where the country's demand is really going up fast. Overall, actually, the world demand is going up fast. And we are integrating this to make, for the first time, right from iron ore to CRGO in India. We have also acquired the technology in this process, and that's a very good positive for the technology has been acquired by JSW Steel. So we will now have the technology for CRGO in India. This product is a high advanced technology product, which very few in the world have. This will provide us much higher EBITDA numbers in terms of because the price of the product is far better. So therefore,
well, that's JSW Steel, and the stock has flattened out completely after starting off lower. But I'll tell you what, the index too and the Nifty should come up on your screen in a moment, because this JSW, but the Nifty should come up on your screen. Look at that, flattened out completely after starting off well. Wonder what ICICI Bank is doing, and I wonder if that is probably one reason, because that was giving that strength. That is still up 2.5%, so maybe the quantum of losses or the losers have gone up. If we can just get the point contributors on your screen in a moment, because I know ICICI Bank is doing on the other side what the best thing, but it is probably the others which are contributing to the downside, which is leading the markets to do what it is doing. L&T, out of its numbers, is looking very, very wobbly. Okay, a quick mention here from Syrma SGS as well, because the numbers came out mixed but had some positives, and as a result of which it's 7.5% higher is Syrma SGS. We spoke to the management, hear out Mr. J.S. Gujral, what he had to say for the quarter gone by.
This quarter has been good for us. And as I had alluded to in my commentary on the first quarter, we service various verticals, and each vertical has its own margin profile. So if in a particular quarter, a vertical with a low margin profile constitutes a higher percentage, the EBITDA margins take a hit. Last quarter, my consumer business was 54% of the total business. We were estimating annualized basis about 39-40%. This quarter, my other businesses in automotive, healthcare, exports have picked up, and consumer business is only 1/3 of the revenue. And we believe this trend for the next 6 months would continue, and we are on line of achieving our top line growth of about 40-45%. with the guided EBITDA of about 7%, 7% plus. So that's the thing. For example, in this quarter, my exports constituted 23% of my revenue. For the half year, they are 19%. So the first quarter, the exports were also subdued. The recovery in exports is visible. We are confident that going forward in the next 6 months, we would be able to maintain the trajectory of our growth and profits to deliver what we had guided the street.
Okay. And a quick programming reminder, NDTV Profit is kicking off its Diwali special programming today with cracker stocks. It's a conversation with Deven Choksi, Amisha Vora and Vijay Chopra on what are the top stocks you should look at this Diwali season. We have an exciting lineup, Niraj. As much as the market's mood is flailing, the fact is that it is a time to celebrate the gains we have made since the year or so, as far as the markets are concerned. It's been fantastic. So a little bit of a profit booking kind of a scenario is perhaps just what the doctor ordered.
Yeah, or celebrate the fact that anybody who hasn't been able to get in gets better prices to get in.
Is that what we are seeing with some of the BFSI pack? Rahul Malani, DVP Fundamentals Research at Sharekhan BNP Paribas, joins us now to talk all things banking. Rahul, great to have you on, and thank you so much for joining us. As you know, we're celebrating this festive season, but we're also talking about what we've seen in the banking pack. Let's start with some of the winners. ICICI Bank, Shriram Finance and Bandhan, if I had to pick three. Numbers which are giving some comfort?
So firstly, good morning and season's greeting to all of you. So basically, if we look at the results of ICICI Bank, it has continuously outperformed the PS on most of the metrics. In terms of asset quality also, if we look at the net slippages have been around 50 basis points annualized, which is even better than HDFC Bank, which is the leader in terms of maintaining the asset quality. So apart from that, deposit growth is also healthy. Loan growth continues to remain healthy. ROA compression, which was expected around in FY25, around 10 to 15 basis points, versus the now it is estimated that ROA will remain stable for ICICI Bank apart from other lenders, which will be seeing compression of around 10 to 20 basis points in the ROI. So, given the current valuation premium, which is trading to, which is versus the peers, is likely to sustain, and more sustained earning progression will help to give further re-rating to the stock, given the sector is going through the various headwinds and challenges, and ICICI Bank continues to remain standing tall in all these things.
Okay. So, sure, ICICI Bank is probably better even than some of the others, Rahul. But the question is, do you reckon that over the course of the next 2 or 3 quarters, until things change, the street and you may want to give a premium multiple to the ICICI banks and the HDFC banks vis-a-vis the others?
See, yeah, you because in the near term there is no re-rating trigger for the whole BFSI sector in terms of profitability or return ratios. So basically, the top leaders, HDFC Bank and ICICI Bank, will continue to fetch higher multiples and higher flows into it, because other banks will be struggling on the asset quality front, because unsecured continues to be around 10 to 20% of the overall total loan mix, which will lead to higher slippages and at least higher credit costs, at least from in the next 2 to 3 quarters. So the outlook remains negative on the profitability as well as the return ratios.
I'm sorry, Rahul. I'm sorry. Rahul, sorry, were you finishing your point?
So basically, apart from the HDFC Bank and ICICI Bank, if we set aside these both banks in the sector, overall profitability and return ratio outlook remains negative, at least for the near term 2 to 3 quarters for the rest of the banks.
I just, there was a lot of commentary since morning, Rahul, and I wanted your take on this, on how the smaller lenders are going to start feeling the heat when it comes to the quality of assets in microfinancing. Which do you think are the most vulnerable? So, for example, we've seen IndusInd Bank already being hit and IDFC. Do you think these are going to be some of the vulnerable ones, or Credit Access Grameen perhaps?
See, already if you look at the price damage has been made in all these stocks. So basically, it's a matter of time. The current expectation is that the pain will be continued for at least 2 to 3 quarters. So we believe that they will continue to underperform in the next 2 to 3 quarters as of now. But already price damage has happened, so we do not feel that there would be much downside from the current levels. But overall outperformance will not be there in the next 2 to 3 quarters per se.
Okay. Just one more question. IDFC First Bank is due to speak to us in a moment, Rahul. Any thoughts on that one? Would you be a buyer? Would you avoid it? Any thoughts here?
The IDFC First Bank is not in our coverage. So
so let's leave it out. Okay, fair call. In which case, anything, Rahul, very quickly, anything within the NBFC or the banking universe which was a shocker, which you will not buy even if the prices come down until things change fundamentally?
See, as of now, the cautious stance have been maintained on the MFI, NBFC's MFI. Other than that, we will be watching out for the trends where the NBFCs like Nalwala, FinCorp and other NBFCs which have unsecured personal loans, higher exposure to this, will see underperformance, while the vehicle financiers specifically will continue to perform well in at least from the near term to medium term perspective, because all these things will because overall the outlook continues to remain robust, at least from the profitability or return ratios perspective, at least from the next 1 to 2 years.
Okay, Rahul, we'll leave it at that. Thanks so much for taking the time out and being with us. Really appreciate your time. That's the view from Sher Khan on the banking space, and clearly a bit of a avoid on MFIs. That seems to be the consensus. Anybody having exposure to unsecured personal loans is an avoid, simple because of the nature of the commentary that has come in around some of these lenders, if you will. Now, IDFC First Bank is in focus as well. Vivya Dhanathan, Managing Director and CEO of IDFC First Bank. It posted second quarter earnings. Asset quality took a hit, unfortunately. Let's hear him in conversation with my colleague.
So this was a bit of a freak incident that happened because the concerned state government made toll free. So our client for entry and exit out of Mumbai, and our client got stuck in the midst of this. It's a force majeure incident that happened. By the way, this client, our exposure was 1,100 crores when we started maybe 5 years ago at the time of merger. This was an account coming from pre-merger times. It came down to 500 crore, or 480 crore. But last, it was still paying. But now, because of this incident, we know they can't service the account now. And we never know when the state government is going to settle this issue with the client, etc. So we didn't want to be hostage for the future profitability of the future quarters. So we took it all upfront. We've taken 100% provision for that account. And that took the profit down by 250 crores this quarter.
What about the microfinance portfolio? So there, multiple banks have come out, banks as well as NBFCs have come out and said that there's been some slowdown, especially in the eastern part of the country, districts showing some amount of delinquencies coming in, largely led by election-related movement. If you can just throw some light as to what your portfolio is looking like.
So we too have an exposure to microfinance. It's a very important part of the priority sector book of the bank. It meets multiple kind of priority sector, weaker section priority sector, small marginal farmer, and so on. So it's an important sector for the bank, and we have been doing this business for 7 years. But of late, there is a stress in that sector for the last maybe year or so, but accentuated recently. It came from heat wave, it came from floods in Tamanna, it came from elections, some promises of waiver, etc. So confluence of many things came together, a bit of over-leveraging and so on. So we saw that last 3 quarters at a stretch, our pre-NPA stage, that is SMA 1 and SMA 2, that has been inching up very sharply. It was like 1.27, now it already touched 2.5 within 2 quarters. So we are like this only. We always take our issue directly. We don't find cute solutions around those matters. So what we did was that normally at 90 days past due, our bank takes 75% provisions, even normally. And at 120 days past due, we take 100%. This quarter, because seeing the stress in the sector, we've advanced that number and we have taken close to 100% provision or 99% provision at the 30 days past due itself. So we just accelerated it so that we just want to recognize the true stress in that sector.
Ahead then, from your road account, of course, there's unlikely to be any stress because of the 100% provision. But from microfinance, is there anything further that you're expecting?
Whatever flows subsequently happens from now on, it'll come. But because we already recognized this issue early on, our flows into a delinquent bucket should be relatively lesser from now on.
Right.
So I also want to quarter, you should see some improvement.
Sure.
Yeah, sorry.
Sure. I also wanted to touch on the credit card book. At this point in time, you are not seeing an elevation in your delinquencies. It's stuck at about 1.4% on the 90 DPD. The industry started seeing that sort of rise in delinquencies. Are you looking at cutting down exposure there on the credit card portfolio?
See, it's very important to understand how a credit card sector is built. And I'm actually happy you asked this question so that I can explain to everybody. In the credit card segment, as you can see from numbers, we have put out the civil TransUnion data about what 30 DPD, 90 DPD delinquency is. We put out our data, and we're significantly lesser in terms of NPA, 30 DPD and 90 days past due compared to the industry. Now, there should be reason for this, for this to behave well. The key reason is that we are lending our credit cards largely to our own customers who are on the savings account side.
Okay.
And our bank is on the savings account side attracting slightly higher end customers. Our average balances are much higher. So since the profile of the customer on the liability side is a slightly higher income profile, and we give credit cards to them, by definition, therefore, that our portfolio is behaving well. We don't intend to change the strategy. We'll keep growing, but we'll be very cautious because we're seeing the numbers of the other players. We will check and double check our practices, our underwriting once again.
Would you say that this is this applies for a broader unsecured space as well? Are you turning cautious as far as that is concerned?
Of course, we are very cautious because we got very cautious. We are always cautious, but about a year and a half ago, we became cautious on this segment because the regulators started talking about it again and again. So we went and tightened all our criteria, and we're happy we did that. Today, our unsecured book is 15% of our book on the retail unsecured. And the the retail unsecured plus consumer durables plus education loans, which is a specific end-use financing, which is also unsecured. That segment put together, our gross NPA is 2.03% and our net NPA is 0.5% only.
Okay.
So we have our SMA, the leading book towards unsecured, is also only about 1.09%.
All right, so that was IDFC First. Let's just pull up that stock. One of the losers of the morning for sure. IDFC First profits have come down nearly 70%, but that's because of higher provisioning. It's actually come off its lows of the day, about 4% down, but definitely off the lows of its day. We'll take a very short break, but before we head into that break, the stage is set for Maharashtra elections on November 20th. And speaking at the NDTV Marathi conclave, Maharashtra's Zahirnama, Devendra Fadnavis, the Deputy Chief Minister, emphasized that exit polls reveal valuable insights into the accuracy of electoral predictions. Listen in.
लोग स्टैटिस्टिकल मॉडल तैयार करते हैं. मैं सेफोलॉजी के खिलाफ नहीं हूँ, और सेफोलॉजी एक साइंस है. इस साइंस में जो आप स्टैटिस्टिकल मॉडल तैयार करते हो उसके आधार पर आप प्रेडिक्शन करते हो. लेकिन कई बार जिस समय एक टाइट चुनाव होता है या जिस समय चुनाव में एक अंडरलाइंग मुद्दे होते हैं, ऐसे समय ये स्टैटिस्टिकल मॉडल फेल हो जाता है. तो ऐसा कई चुनाव में हुआ. कई बार ये यशस्वी भी होता है जब एकदम अंडर करंट होता है. ऐसे समय ये स्टैटिस्टिकल मॉडल ठीक भी होता है. लेकिन मुझे ऐसा लगता है कि हरियाणा के कारण सभी लोग असमंजस में पड़ गए कि भाई ये एग्जिट पोल करना है या नहीं करना है. मैं ऐसा मानता हूँ ये इमर्जिंग साइंस है, इसलिए करते रहना चाहिए.
Thanks so much for tuning into Talking Point and Full House today, talking about the big listing and then talking about a special show. But Waaree Renewables and Waaree Energies should be something that you should keep in mind because the listing promises to be a good one, Tamanna and Samina.
Yeah, and I think we're getting those first rates up. Let's get those pictures in also for Waaree. Definitely 68% up on its debut. Deepak Builders has not been that great, not a mainline IPO in that sense, but Waaree has completely taken it away at a time when IPOs have not necessarily been faring too well. Well, at least a good morning for Waaree.
No, it's fantastic. I think it's slightly not as good or below what the grey market premium was. The expectation was at some stage that the counter would list with a 12 to 1400 premium. 927, I don't think the founders are complaining. It's a significant one. It's a big one. Anchor investors that have come in are also very marquee locally and globally as well. This compares to Premier Energies. That's the other big one that listed recently in the same business, but far more stretched in terms of valuations. Deepak Builders, I'm sort of disappointed because the grey market premium on that one too was indicating to a start with a gap up of nearly 20%. It's actually opened 10% lower. Remember, Deepak Builders was oversubscribed by 46 times. Waaree, on the other hand, was subscribed 76 times. One of the most, rather the largest oversubscription that we've seen in the last few months. So this is a big one. It's settling down as we see it. 2300 or 23.6 is what we have on Waaree Energies. But I think on to a more exciting conversation, or equally exciting conversation, I may say.
Well, yep. So viewers, thanks for tuning into this edition of Talking Point, and let's just set the stage. There is a bearish mood in the market, and some of the reasons why this could be the case: weak Q2 results, the GDP outlook seems to have come off, and a lot of private economists or private sector economists have actually spoken about how Q3 might be weak as well. There are concerns over valuations, and they always continue. So one reason is the GDP outlook lowered. Let's move on to the other reasons as well. Consumption concerns have mounted, and that has always been something that is people are now starting to talk about after Q2 results. And last but not the least, the rate cut uncertainty in the US. I think that is probably the big one. And let's get in our guests to talk about the same. Rajiv Batra of JP Morgan with us to talk about his thoughts on what's currently happening. Rajiv, great having you and to you and yours out there in Singapore. A very happy Diwali and a prosperous new year. Good talking to you today.
Thanks, Niraj. Happy Diwali to yourself, your viewers too.
Thank you, Rajiv. Now, Rajiv, I remember a conversation that we had at your investor conference wherein you had mentioned that things may wobble a bit in October, but they may change for the better post-October. I would love to understand, does the theory still hold, or does a possible reflationary trade because of a possible Trump victory change that outlook a little bit?
No, all the points which you have just mentioned a few minutes back, this is what we were alluding to when we came out with our report back in August and September, that this is the period in October and November where we will revisit. Markets will take a breather, some consolidation will there. And most importantly, you will be seeing a furious rotation at a sectoral level where you will not have any clue whether we are moving defensive or cyclicals or large cap or mid cap. That's the phase we are in right now. But the good part is a sizable amount of a correction is over, and maybe a 5% down the line from here will get India back to the trend valuation, which most of the foreign investors and long-term investors are eagerly waiting for. At the same point of time, whether it will be a red sweep or a blue sweep, neither of them in the sweep scenario have talked about a fiscal consolidation. They are still talking about a fiscal support, which will be positive for the risky asset classes, global equities overall. That's a different point, who will outperform and who will underperform. But just jog your memory back to 2017. Once the 2016 election was over, we saw 35% return in EM equities and close to 20 to 22% return in DM equities. So people who are extremely bearish on the markets or even on India needs to be a bit cautious from here on, taking that kind of an opinion and sentiment for 6 to 12 months basis.
Interesting. So Rajiv, sorry, am I getting this straight that you say that at these mean valuations, assuming there is a 2-3% further correction, would you be a buyer? Part one is that. Part two, flows, Rajiv, is the big thing, right? Over 1 lakh crore of outflows in October. Now, do you believe that can reverse in November? Because I remembered back then in September, you were talking about a possibility of large global funds moving into emerging markets like India. Can you talk a bit about that? Flows.
Yeah, and after a chat, we saw what happened in a day or two. China unleashed one of the biggest stimulus packet and support to the markets. So that's where the first installment of outflows happened in India, where not only foreign investors started neutralizing their overweight on India and going to making China a marginal underweight or a neutral territory, but even the domestic investors in India were subscribing more to China-based fund in the first week of October. So that was the first jolt India received. After that, to put entirely blame on that money is rotating from India to China is absolutely a wrong notion, because we have seen money have been going back to the US or precious metal like gold, silver, even some places cryptos too. So the US election uncertainty, and most importantly, the stronger data points started coming back into the US market that made people shift towards dollar asset class, and hence India, which was one of the well-owned market along with some few other markets in EM by foreign investors, that gone into a profit booking kind of a mode overall. Now, can money make a comeback over here? My answer is absolutely yes. Remember, nobody was giving a chance of India getting FI flows while we were going into the Indian elections in June. But what we saw after the election result, from June early start onward till almost till September end, India received $16.5 billion inflow in matter of 3 to 4 months. So once the risk of sentiment goes away, markets get a clarity who is the US president, who controls the US Congress. We get the clarity from Fed to what kind of a cycle or a path they are adopting to. I think the normal service will resume in market. For now, coming up from a very high level with kind of a returns which India along with other markets like Taiwan, Malaysia, even with US equities they have generated, there is an expectation of some kind of a breather and consolidation in market happening. And we are exactly right now in that situation. Does the long-term path change for India? Absolutely no. We continue to maintain our structural overweight on Indian equity market.
Rajiv, hi, good morning. Tamanna here. The tough bit right now is to quantify when does this long-term structural overweight outlook kick back in? When does this period of uncertainty end? Do you think that the rebalancing that you talked about in favor of China is at the fag end of its process, or there's more pain to go?
So first answering on China. So in case of China, the process is still on. As we are talking, they will be going into the policy making meeting next week, and there are a few more meetings to come in December. China definitely is trying the level best to come out of the problem which they are facing in equity markets, in terms of a higher debt level or in terms of a real estate markets too. So they will try to, they do their level best to generate a higher growth and resolve this issue. JP Morgan has revised this current quarter GDP growth in China higher to 6.9% quarter-on-quarter basis. And even for the first quarter next year, we are calling for 5% growth. But beyond this near-term jump in growth, we still believe headwinds persist in China. And that is the reason why our advice to investors have been to be neutral on China, which means they will keep on looking for a sustainable growth places or countries which can offer them earnings visibility and clarity, not from 1 or 2 quarter perspective, but at least for 3 to 5 years perspective. That's where India sits. Now, what can give back that confidence to investors that India is on that path? We definitely need to see high frequency indicators start moving up. Recently, we saw a 40-month low GST print, a kind of a year and a half low PMI prints over there. So that data points came down in terms of heavy monsoon season, which we have, which impacted demand, and then lower spending from government due to elections and then monsoons. But all these factors are going to change, where we do see government spending expected to pick up in the second half of this fiscal year. The cyclicality of rural consumption have not been clicked in yet. That will also start with ongoing festive season plus marriage season that will become. And last but not the least, the base effect. Remember, now your first half base effect is quite low. So even if you perform little bit higher over there, the amount of jumps in the growth in Q-on-Q basis in third quarter, in fourth quarter will be way significantly higher. So I will again caution, you have seen the negativity in first quarter, second quarter, but don't extrapolate it to the second half of this fiscal year, because we do anticipate second half of this fiscal year, growth will kick back along with some support from private CapEx too.
Hi, it's also Samina joining in. Domestic investors have a home bias. So what should long-term investors do? While nobody argues, or there is a clear consensus that we are in a structural bull run, intimate volatilities are very difficult to stomach if you're a long-term investor, right? So what should the strategy be? Buy more into this weakness? If yes, what do you buy? Do you buy banks? Do you buy consumption? Do you buy IT? I mean, the universe is large, though restricted and limited for most investors to India.
Thanks, Samina. I will say that the Indian equity investors are quite smarter than the domestic investor, because we have seen they only follow one factor of investing into the market, and that is earnings and earnings momentum. So there are spaces where there's a structural kind of a support in terms of an earnings and growth. So power is one such ecosystem and theme that will keep on doing well for multi years overall. Similarly, on the healthcare side also. But on the other spaces, as you mentioned, be it financials or consumption, there will be some cyclicality clicking in. Right now, we have seen a cyclicality clicking in for consumption also. We had very good second quarter in terms of performances, or even early third quarter also for consumer staple sector. But as earnings kicked in, consumer staple sectors and defensive started going down overall. But does it mean that theme is over? That theme does not have leg. When we look at the macro indicators, the GDP per capita, or when we look at wages or rising in incomes overall, that still remains supportive as a theme. So the only lens we should apply on is earnings, and taking that into account, there are some structural themes and there are some cyclical themes. Beside power and healthcare, I will say even the capital market intermediaries, because even today, the household balance sheet is not fully exposed towards equity and equity-linked investment. So capital market intermediaries will do well. And then, based on the cyclicalities of earnings, the tailwinds are behind your IT sector. There is some tailwinds behind even your industrial spaces or cement spaces overall. So that's what the Gauss people will need to do in. And I will say that if one needs to invest in the market, it has to be in a regular, healthy SIP, or you can say in investment monthly or a daily or a weekly kind of a mode, so that that healthy practice remains. Because India's GDP growth is expected to remain above potential, at least in a relative term compared to the other EM markets, other Asian markets, which means the risky asset class in India will keep on doing well relative to their global EM or a DM counterparts.
Just, you talked about where the tailwinds are, but in the context of the quarterly numbers as well, where do you see the largest pain points or any areas of concern?
So I will say too early to say on earnings right now, because so far this mid cap has not even started. We have large cap largely in, and most of them were IT spaces who have given the earnings. So definitely revenue, if we look at X financial, is still disappointing. YOY basis, it's almost flatlined over there, and in line with the expectation, earnings, that is bottom line on a YOY basis, are only X financials 2% up, but disappointed based on the JP Morgan forecast, which was plus 3%. That's the ongoing run rate. We will see how the earnings progress overall. But the top line disappointment coming is a concern. And we hope that it's an aberration just for first half of this year, and things start improving in the second half on the top line side, because margins will be difficult to defend if you don't have much support from factors of production, particularly from input prices. So hence, this is the reason why I'll say top line for slowing down is more a concern for me in this ongoing earnings season.
All right, thank you so much, Rajiv, for speaking with us today. Rajiv Batra there saying that tailwinds still exist for quite a few sectors, and the long-term story on India continues to be positive. In the short term, though, we are feeling the pain. And Manav Chopra now with us. He's Director Technical Analyst, Nuvama Institutional, in our studios. Manav, great to have you here.
Thank you.
You know, and even as we're kicking off the festive season, it's not looking too festive out there.
True.
More pain in store.
Yes, I think, looking at the overall structure of the markets, we are in an intermediate correction of a larger bull phase. So there is, the short-term correction is what the markets have been used to overall. You see a quick 4-5% kind of a dip and market makes new highs. But, this time around, my sense is that we have already made an intermediate top. I think to our previous discussions, we were calling for some bit of an exhaustion in the mid cap, which has seen a reasonable amount of decline. Absence of any leadership in the frontline names, take most of the sectors. I don't see any of the sectors forming new highs in times to come. Barring few sectors like IT or maybe select names from financials. But largely the sector construct has really been dampened in last few weeks, along with the broader markets. So, you might see an odd trading bounce. The short-term sentiment has come to a near-term oversold levels. You might see an odd trading bounce. But my sense is that the broader construct would be similar to what we witnessed in October in 21-22, where you were grinding, forming a correctives rallies over the period of 3 to 4 months. Similar in the first, initial months of 23, where you did see a 3 to 4 months kind of a decline. I think this is what the market is going to see over the period of time, and any trading bounce might be led with some short squeeze formation, but largely the construct of the market has been on the intermediate correction zone, and that's my sense you'll be seeing in next few months.
Manav, the last time we spoke, which was maybe a week ago, you talked about a 10-15% correction in the broader markets.
Correct.
The mid-cap space is in a 10% correction. It's officially gone into a correction phase, like they call it, from its recent highs.
Right.
If you do anticipate some more pain, where will the pain come from? And I think just before this correction began, the argument always was, will it be a price correction? Will it be a time correction?
Right.
It seems like we've done a price correction, and now you're saying that there could be a time correction coming away. So give me a sense of what more. I mean, you buy in a correction phase, don't you? Or
yes.
start nibbling in that sense?
We do. So let me just give you a little bit of back end. So we have seen a rally of 6 quarters non-stop in the market. Let it be your broader markets or your frontline indices. And I haven't seen historically, even post-COVID, after 6 quarters is when you started getting into a corrective zone. So sentimentally, we were at the highs. And a pullback or a sideways traction with the price correction is going to create a platform for the next bull market. I mean, it's easier said than done now, but how do we navigate this intermediate correction is going to be challenging. If you look at the Nifty Infra Index, which constitutes of your cap good names, some of the cements, your power utilities, they have actually started to crack down. And when we see a sector like that also giving away, it calls for poor market breadth eventually, which will lead for some more laggard. So my sense is with small cap index, which has a very, very strong support at 17,800, 18,000, which has been, which is a neckline of an important head and shoulder pattern. Once that starts to give away, you might see more pain coming in. What is holding the frontline names is your heavyweight names like MCX, BSE, CDSL, Glenmark. In case if any of these capital market names starts to give away some profit booking, the frontline stocks which are holding the small and mid caps, that will create some more pain in the markets going forward. I think it happens on immediate or maybe after a few weeks. I think the time will decide, but we have been quite aggressively telling clients to trim their positions at least in this mid, hide in the low beta. The navigation is going to be difficult, but we'll wait and watch how it goes.
So, Manav, you are not buying anything. What is it that you are comfortable selling after the pain that has already come about?
Sure. So, in the recent few weeks, the only sector which is reasonably at, near to highs, which are seeing fresh breakdowns, is your cap good names. Let it be your Siemens, ABBs, or even Cummins. This is a space which have started to form the first initial of a lower high. It's not yet breached its recent lows to form its a lower high, lower lows formation. I think the cap good names will start witnessing some more pain, at least, which could last for a few more months. This sector has been in a very, very strong uptrend of 5 years. So possibly a few months or maybe half a year of corrective decline, very much there on cards. So this is one space where you will see some pain coming in along with these cement names, and power utilities for that matter, has been doing a good amount of rally, which has been the savior in the public sector space, and any fresh breakdowns is definitely a thing that we are quite cautious about.
Is there any opportunity at all to buy in the large cap space, because they've been bearing the brunt despite not witnessing the good times in so many ways, right? So any of the frontline names that you think may be showing early signs of adding, so your Infosys, right, Wipro, RIL, HUL, I mean, look at what happened to them on Friday.
Absolutely. I think one sectors which we are recommending clients to be in low beta or start nibbling longs, it has been IT for a while, but now the FMCG space have declined close to its 100-day, 200-day average. So we've seen historically in any tough times, FMCG index usually tries to form an early base around the 100-day, 200-day average. I'm not sure about the construct of whether to be aggressively buying HUL, but what we are recommending is names like BBL or names like Britannia. As the segment of FMCG, I think you might not see a V-shaped recovery, but some base formations, at least in these names, is where hiding is there. The insurance names are also kind of likely to be a bellwether in this scenario with some frontline private banks like ICICI. So that's the only space, nothing being very aggressive, because I think for the near term you might see some better opportunities, at least at lower levels.
ICICI over HDFC and any of those larger NBFCs that you are finding tempting right now?
See, the NBFCs in such markets, where you see some bit of markets getting weakened in the broader space, NBFCs usually gets hit equally. Barring few names, but largely I think NBFC, the structure still remains quite weak. I haven't seen any bit of a recovery. There might be a short squeeze bounce, but not that I'm expecting a good, meaningful buy and hold kind of a scenario coming for the NBFC's name. So when we're looking at the financial Nifty chart in general, it's been quite range bound only because of some private banks holding the guns, but largely if the bank Nifty is in a range of say 5,500 to 52,500, and that has just been the savior from the private banks. So my sense is that the NBFCs would be an avoid, but certain private banks you might just want to have that place to hide in, nothing like a aggressive buy and hold.
Which are those apart from ICICI?
So at the moment it's ICICI and HDFC Bank, which looks fine, but the broader construct even in the other private names are on the weak foot.
What about an HUL, ITC, Tata Consumer? And I ask you this because ITC for the longest time has been called the Rahul Dravid of this market. I think people have changed their mind after what we've seen over the last 10, 12 days. Right. But not accumulating those names because they are defensive and they are supposed to be bought when the markets generally aren't feeling great, right?
I think a lot of rules of the markets have changed. We have seen where people would talk about hiding in a lot of the FMCG, but it's become very, very stock specific within the sector itself. I think the sentiment of the markets in even certain names have changed a lot. I'm not sure about HUL at the current juncture because it has actually violated key supports, but just nibbling into certain ideas in a phased manner is only what we would suggest. But in the pecking order for us, ITC is still an avoid name, and we would still want to be with names like Britannia or VBL for that matter.
What is the Nifty outlook?
Okay, so for a medium-term perspective, I'm not expecting Nifty to go beyond 25,000, 25,200. My sense is that yes, we have declined from the recent peak of 26,500 all the way to 24,000. This is the zone where the short-term sentiments are at the oversold levels. Let it be your breadth, let it be your short-term momentum, or even the sectors. They are at the short-term levels where you might see a short-term trading rally. But in the medium term, I think eventually the market would be grinding on the lower side. My medium term, long term, at least I anticipate that the right or an aggressive levels for the Nifty one to initiate for a medium to long term perspective is still wait, but a possibility of down towards 23,000, 23,200. And that's when we would want to go for more aggressive stance. But I think in times to come, you will be seeing those levels, not on the immediate basis, but in next few months.
And how much more on the Nifty in terms of downside, A, and B, I find it hard to believe that your trading desk is not calling clients right now. What are you calling clients and telling them? Because everyone wants to do something even in a falling market, right? So I know Niraj asked you what you'd sell, but just build on that a little bit more. What are they doing? What is your team doing is what I want to know. You can't go quiet for sure.
Of course. I mean, that's on the sell side. We have to always be engaging clients. But the perspective is that, managing risk in this scenario is the key important thing. Not taking an aggressive bet is also one of the calls that we've taken recently of, shifting our stance from the high beta names or the mid caps getting into the low beta names. We are evaluating some stocks which are coming at key levels, at least on the sectoral front. That is only the part we are negotiating.
Which ones are those?
So, like I mentioned, it's
Britannia
from the
we've got,
insurance names. We like HDFC, ICICI, PruLife, iBank, and obviously within the IT, it's Tech Mahindra, Infosys is something that we are ready to navigate in this scenario. But given the stance, I think for short-term traders, we are recommending the few sectors which might see some bit of a short squeeze is going to come from the metals and real estate, but not something like we would want to buy and hold, at least in the near term.
Well, not doing anything is also doing something. So in that sense, it's worth it. Okay, great. Mana, good talking to you. Thanks so much for taking the time out. Really appreciate your time. And viewers, with that, it's a wrap on this edition of Talking Point. Thanks so much for tuning in.